Hi everyone, my name is piterpakulski. Today I would like to show you the final version of a financial model of a yoga studio. I will show you what parameters affect the financial efficiency of this type of business. I will go through the model. I would like to show you what interesting things usually entrepreneurs want to look at when they see the final version of the financial model, what parameters they usually want to play with. So I'll just go through the model from top to the bottom, and I'll be showing you everything. So what I would like to start with is that all inputs are marked with the specific blue color. So all inputs in our financial model are marked with blue, so other cells are automatic. We don't put any data inside these cells. So first of all, we just name all types of yoga classes that we have. So different types of yoga, we just name it. Here we just create a special block of inputs where we are able to switch on and switch off different types of yoga classes to make us able to see the financial efficiency with or without this or that type of yoga, because maybe we are too optimistic. For example, when we create when we've already created the cash flow statement, when we see, for example, the financial efficiency, when we see the simple and discounted payback of our business idea, then we, for example, think that maybe we are too optimistic with this or that types of yoga that we've included in our schedule, so we just switch them off, for example. And then we go to the payback period diagram. Now Microsoft Excel is calculating the new picture of scenario that we've created, and now we see how our actions affected the simple, discounted payback period, financial efficiency, net present value, and so on. So such buttons are very important for scenario planning because when everything is ready, everybody wants to switch on and off different types of yoga to see the performance with or without this or that type of yoga. Then we set up the amount of people in a class. Then we have a coefficient. The basic value of this coefficient is 100% for amount of people in a class. For example, we don't want to adjust this. This is all needed for scenario analysis, because when we see the financial efficiency with this amount of people in a group, then we, for example, want to increase the amount of people, for example, on 30%, and see what will be the financial efficiency in this case, for example. So we don't adjust these values, we just only percentage to see if that's possible, and if not, we just go back to basic values of our inputs. So this system of coefficients and buttons of switching on and off is very valuable for scenario planning. So it is vital, because your financial model has to be easy adjustable. So this is very important for future steps when you will see the values of net present value, profitability index, and so on. So then we specify the duration of the class in hours. This will be needed later for schedule modeling. Then we set up the average check per person per one class. Then we add a coefficient for this value, also for scenario analysis. Then we have direct costs per person per class. Also have coefficients for direct costs. Then we have some direct expenses per class. Here we can just specify what types of expenses we can have just per one class for each type of yoga. I don't know what types of expenses it can be, but still Here we just name all these expenses. Here we set up the values for these expenses. Then we have an additional coefficient to total expenses. So this is all needed for scenario analysis, because when financial model is ready, everybody wants to play with all range of parameters that affect the financial efficiency. What we're doing now, then we specify the working hours from Monday to Sunday. So we just specify how many hours per day we are working. So why we need that? We need that because here then our next step is creating the schedule. So the problem of any financial model is that we have to create the revenue generating algorithm that we will trust. To create this algorithm, the best thing is to create some kind of real schedule from Monday to Friday to see what will be the revenue, what will be the expenses. If we have the schedule, for example, in Monday we have yoga type 12, type 5, for example, we can add some another type of yoga. So if we add a new yoga, we will automatically see the numbers here appearing here. So this will be the revenue, direct costs, amount of people in a class, duration, and it's very interesting to play with this data, because here we see the total time of these classes out of 100% of time for Monday. For example, if we add too much lessons, for example, let me add some lessons here. So as you can see, we have 100% and 20% of time. This means that we don't have so much time for this amount of classes. This means that we have to decrease the amount of classes inside Monday. We just have to delete and go back to real numbers. So this is the system that will control entrepreneur from setting up the wrong inputs inside the model. This will bring you back to reality. And when you just start thinking about the schedule, you will create the real algorithm for revenues, direct costs. This is very important, because creating this type of model will show you plus minus the real revenues, the real expenses, the real amount of financing, the real profits. This is very important. So we do the same for Monday, Tuesday, so all day of the week. So when we've created the schedule, then we would like, for example, to add some coefficients for seasonality of this business. So for example, then we just take the typical year from January to December, and assume that in January we have 100% of revenues and expenses that we've just created in our schedule. But for example, in summer months, our revenues will decrease, and the seasonality coefficient will affect the revenues and expenses. So we can use this coefficient to adjust seasonality of revenue and direct expenses. So this is also very important, because in summer months we may have some operating losses that will cause additional, for example, financing, and playing with this coefficient, with seasonality coefficient, may bring you lots of interesting questions when you will see the cash flow statement, when you will be able perhaps see operating losses during during summer months, for example, when the revenue will decrease, and you will be able to accumulate cash to cover cash gaps, so operating losses. So this is very important. Then we specify finally when we start our operating activity, when we open our yoga classes. So we specify month, we specify year when we start our business operating activity. Then we go to the next block of inputs and assume that, for example, when we start our business, we won't get the maximum of revenues just for the first month. We just assume that on the first month, when we start operating activity, we will get just, for example, only 3% of our planned revenue. On the second month, we will get 5%, then 7, then 20, then 40, and this percentage will rising till we get 100% of our revenues. So why we need this block of inputs? This block of inputs is needed to show you the possibility of operating losses. I will just go back a little bit further to cash flow statement, and here we can see September when we start operating activity, and here we see the revenues, direct costs, for example, fixed costs, payroll, taxes, and here we can see 2 months with operating losses. This means that during September and October you need some additional financing to plus financing that you invested in during the investment stage. So this will show you that you will need some additional financing, and then you will have to play with these inputs. For example, if you reach faster or slower the planned revenues, and you will see additional operating losses. So playing with these coefficients will show you the gap of maximum and minimum of financing that you will need to start the business. This is very important block of inputs, because you won't get the maximum of revenues right for the first month. So pay attention to that. This is very important, because if you just assume that you will get the 100% of revenue on the first month, you won't be able even see how much financing you really need to start the business. So then we move to investment stage. Here we just mention what we invest in, how much we invest in, when we invest in, month and year. Then we mention fixed costs items, for example, rent, advertising. This is the fixed costs names. Here we can see the values of fixed costs. Then we cover payroll. Here we name the positions. Here we just mention how many people on each position we have, what is the salary of one person on each position. Then, for example, if we have a loan, we can specify the year, month when we get this loan, the amount of this loan, the interest rate, term of the loan, grace period for principal payments, for interest payments if we have any. Then we specify the value of revenue tax, profit tax, payroll tax, asset tax that we pay per month. And then finally we go and we reach cash flow statement. Here it is. And here we are able to see automatically how much financing we need. For example, if we have only equity, then we can see here how much equity we need to start the business. If we, for example, have a loan plus equity, we can add a loan here. Inside cash flow statement, we can see the total revenues, total direct costs. We can use plus button to see the detailed revenues. Also, we can see the net profit from operating activity. Inside cash flow statement, we can see the growing cash balance of our investment project. Looking at this cash balance, we can see maybe we need some adjustments for inputs, so we start creating use scenarios when we first see the cash flow statement. Then we just create very simple table for total revenues, total expenses, total profit, profitability. Then we create the data for simple and discounted payback period calculation. Then we have the simple symbol diagram for simple and then here we just set up the discount rate for our investment project and the step of adjustment of this discount rate to calculate the internal rate of return. And when everything is ready, for example, we create the special block for sensitivity analysis because, for example, we would like to let me create some scenario. For example, we would like to see what will happen with financial efficiency if we take the revenue from yoga class number 5. We will just add a parameter of sensitivity analysis. And now we will test financial efficiency, what will happen if the revenue from yoga class number 5 will rise or decrease, what will happen with simple discounted payback period, what will happen with amount of financing that we need to start the business. So I'll just push sense button and just start testing the model, what will happen if. So now we've tested our financial efficiency, what will happen if the revenue will rise or decrease from yoga type number 5. And when we see these numbers, these values of financial efficiency, so we are able to just take this parameter away from yoga number 5, add this parameter to, for example, investment plan or direct cost or whatever parameter we want to look deeper the effect on financial efficiency. So we just add this parameter to any input and start testing financial efficiency. So this is very valuable instrument when financial model is ready. It is easy to create in multi-scenario situations to see what is the key success values of this or that parameter for your business idea. So I suppose that I mentioned all the inputs. I mentioned all interesting things you would like to know about Yoga Studio financial model. If you start modeling Yoga Studio this way, I suppose that you will trust the numbers that you will get at the end of the model. This will build for you the clear picture of your business idea. So I hope you like this video. You may give us a like, subscribe our channel, share this video with your friends. Also, you can order a financial model from scratch for your unique business idea or for your working business. We can help you with that. So see you next videos. Thank you and bye.